Welcome back to Simple Accounting, where we make accounting concepts easy to understand. In today's video, we'll be diving into the world of T accounts. T accounts are an essential tool for analyzing and organizing financial transactions. So let's get started. A quick recap of the double entry bookkeeping system or system showing where T accounts fit in. An account is a record of all transactions for a certain group of items. These groups are classified as assets, expenses, or equities, as shown in the previous video, debits and credits made simple. A T account is a visual representation of the general ledger. It consists of two sides, a debit and credit. It looks at one account's debits and credits together. The general ledger is where a business stores a complete record of all of its financial transactions, an exhaustive list of the accounts and their debits and credits. Let's go through an example of how you'd set out a T account. A business has a bank account where all expenses go through. They have an opening balance of £1,000, then pay a bill for £200. After that, they make the decision to buy £500 worth of inventory, making their total spend £700. 1,000 minus 700 leaves the business with £300 in their account. When making a T account, the right side is the debit and the left side is the credit. The name of the account goes in between the two. A bank account is considered an asset. That's a debit account. In order to increase a debit account, you would debit the amount, and to decrease the account, you would credit the amount. If the account is a credit account, the opposite is true. In our example, the opening balance of the bank account is £1,000. The £1,000 will be placed in the debit side. The bill payment of £200 is placed in the credit side. Why? Because by spending £200, money has left the bank account. As the bank account is a debit account, to decrease the amount, you credit the amount. The same goes for the £100 worth of inventory purchased. The closing balance is then placed on the debit side because the overall account is in debit of £300. Now, what if the expense caused the business to enter into an overdraft? In that example, let's say that both the bill payment and the inventory purchase doubled. And the same procedure would follow. Amounts decreasing the account are placed on the credit side. However, the closing balance moves to the credit side as you're now in credit with the bank. The overall account is now credit by £400. These examples only show one half of the double entry bookkeeping system. For every transaction, there are two entries. In the examples, we've only made the entry relating to the bank account. We'll now go through 5 worked examples that require both entries. Number 1, the business owner invests £1,000. Number 2, the business receives a £200 loan. Number 3, £400 is spent on acquiring equipment. Number 4, purchasing inventory totals £600. And number 5, 3/4 of the inventory has been sold at a 30% markup. Let's start with number 1. An investment of £1,000 from the owner would impact the business's cash and equities account. Cash is a debit account, so we debit the cash for £1,000. Equity is a credit account and is what the business owes to its owners, so we credit the equity account with £1,000. Number 2, the business receives a £200 loan, which would impact its cash and loan accounts. A loan is a liability, so it is a credit account. Therefore, we must credit that account with £200. In return, the business's cash account will need to be debited by £200 to show the increase in cash. Spending £400 on equipment would impact the business's assets. Cash and equipment will need entries showing the shift. As cash has been spent, we would credit the cash account with £400. We then debit the equipment account for £400. Number 4, purchasing inventory that is valued at £600 impacts the cash and inventory accounts. Decreasing cash means that we credit the cash account with £600 and we debit the inventory account by £600. Number 5, 3/4 of the inventory has been sold at a 30% markup. This question requires a few more additional steps. First, we need to work out the amount of inventory being sold. Number 4 states that we bought £600 worth of inventory. 3/4 can be written as 75%. So we would do £600 times 75%, giving us 450. The 450 has been sold at a markup of 30%. So what we would do is take the 450 and times it by 130%, giving us 585. To calculate the profit made from the sale of the inventory, we will take the 585 made in cash minus the inventory sold, which gives us £135 in profit. Going back to the T accounts, we will debit the cash account for 585. We credit the inventory account by 450 because it decreased by £450. Last, we would credit the retained revenue account with the profit made of 135. Overall, the T accounts together give us the general ledger. Closing off the accounts show that the debits and credits are balanced at 1,350. T accounts are the building blocks of the double entry bookkeeping system, helping us keep track of the financial health of a business. Understanding this concept is critical for anyone interested in accounting or running a business. If you found this video very helpful, please give it a thumbs up and subscribe to our channel for more accounting videos. As always, feel free to leave any questions or suggestions in the comments below. Until next time, happy accounting.